Good afternoon and welcome to the SILA Foundation August webinar, providing an update on AI regulatory market in the insurance industry. My name is Julie Mendel and I'm the Education Trustee for the SILA Foundation. Before I introduce today's speaker, I do have a few housekeeping items for everyone. Our webinar is 1 hour in length and is being recorded. Within the next week, you will receive a link to the recording and a post-webinar survey, and we would really appreciate you completing that. We ask that you mute your microphones and turn off your videos so the focus can stay on our speaker. We also ask that you put your questions in the chat box. We will be monitoring and posing the questions to the speaker on your behalf, and we will answer as many of the questions as we can at the end of the webinar. If we're unable to address questions, you can email them to us and we will respond within the next few days. Today's presentation will provide a timely and comprehensive update on the rapidly evolving artificial intelligence regulatory landscape, specifically impacting the insurance industry, with a particular focus on the U.S. regulatory environment. We will delve into the complex interplay of data, privacy, and AI, cover key federal and state privacy laws, and address how these intersect with the unique challenges posed by AI. The discussion will highlight emerging state-level AI regulations and analyze their implications for insurers, and we will hear about recent initiatives by the NAIC. This is a really packed webinar, so I'm going to introduce our speaker. We're going to dive right in. So today's speaker is Fred Karlinski. He's a shareholder and chair of Greenberg Trorig's, Global Insurance Regulatory and Transactions Practice Group. He has over 30 years of experience representing the interests of insurers, reinsurers, and a wide variety of other insurance-related entities. As a recognized authority on national insurance regulatory and compliance issues, he's taken a leadership position in many industry trade organizations. He's been listed in the Best Lawyers in America Super Lawyers, Florida Trend 500, and Florida Trend's Legal Elite for his work in insurance law. GT's Insurance Regulatory and Transactions Practice, led by Fred, was given a Legal Team of the Year finalist award at Business Insurance's 2024 U.S. Insurance Awards Program and was named Legal Services Provider of the Year by the Insurance Insider at the 2024 U.S. Honors Awards for the insurance industry. In addition to his role with GT, Fred has been an adjunct professor of law at Florida State University's College of Law since 2008. He's also the chair of the FSU Law School's Board of Visitors and chairs the Florida Supreme Court Judicial Nominating Commission. Please join me in welcoming Fred Karlinski back to our virtual webinar stage.
Well, thanks very much, Julie, for those comments. Appreciate it. And thanks to Mary Ellen and Sherry for all the work you guys do and for helping put this on. And let me just give a quick public service announcement. This was not in my script. I wasn't asked to do this, but I will be at the conference in October in New Orleans. If you haven't already registered, you need to, because it is filling up quickly and it's a great conference. I look forward to seeing you, many of you there. Let me also thank the team at GT for helping put this together. Chris Brito, Jake Gatto, and Chrissy Curas for helping me get on with the show. And so before we start, let me just give you a quick disclaimer. So our general counsel's office is happy. None of what we're going to talk about today is legal advice. If you need legal advice, call us. This is a free webinar. We're going to make you pay for that legal advice. But no, all kidding aside, just FYI on that disclaimer. And then last but not least, before we get started, just want to make sure that people understand that we operate under certain antitrust guidelines when we do webinars like this. So on the next slide, you'll see an antitrust statement. You can all read it. It's consistent with what we do at SILA. And by the way, I think this is like my 10th webinar that I've done. I almost always do it this month. And so I'm in New York right now, which is where I normally am this time of the year, because I go to the US Open and the weather's pretty darn nice here right now. So let's get on with the show. We have a lot to cover. I don't know that we're going to get to it all. As Julie said, we're going to get you the slides after and answer any questions that you might have. I think we're going to at least get to the first 3 sections. Privacy is inextricably tied to AI. If we can't get to that and can't get to questions, we'll send the slides to you and we can answer any questions by email. So with that, let me just say that as we get into the first section here, the focus really does shift to the application of artificial intelligence in the insurance industry. This topic represents a forward-thinking and forward-looking perspective on how technology is reshaping regulatory practices, claims handling, underwriting, fraud detection, and consumer engagement. The integration of AI tools is not only enhancing operational efficiency, but it's also introducing new challenges and considerations for regulators. The discussion that we have today will explore both the opportunities and the oversight responsibilities and challenges that come with the adoption of AI in the insurance world. And so what we're seeing now is that the insurance world is really going through a significant transformation that's driven by the rapid adoption of artificial intelligence. Over half of the insurers out there are now using generative AI, and the technology is being integrated across core functions such as underwriting, claims processing, marketing, and fraud detection. What began as isolated pilot projects and programs is now evolving into enterprise-wide deployment strategies. The projected market size for AI in insurance is expected to reach over $141 billion by 2034, reflecting both the pace of innovation and the growing reliance on data-driven decision-making. However, this growth trajectory is not guaranteed. Nothing is, frankly, in this world, as you know, but it will be shaped in large by how regulators, legislators, policymakers in the industry respond to emerging concerns around fairness, transparency, and accountability in AI applications. As regulatory professionals, we're really entering a critical phase where our guidance could potentially influence not only compliance, but it also could influence the direction and sustainability of AI adoption in the insurance sector. Artificial intelligence is no longer a future consideration for insurers, but it's a present-day catalyst that's reshaping our industry. We're evolving beyond traditional predictive analytics, which rely on historical data to forecast outcomes, and onto generative AI. These models can reason, automate complex workflows, and deliver highly personalized services. Key applications include underwriting powered by the Internet of Things and telematics, fully automated claims processing, sophisticated fraud detection systems, as well as AI-driven customer service platforms. These innovations are not just enhancing operational efficiency, they have the potential to redefine the customer experience. Insurers that successfully scale AI across their operations may be likely to gain a clear competitive advantage. They're often able to respond faster, reduce costs, as well as offer more transparent and tailored interactions. These capabilities are likely to redefine the customer experience and set new benchmarks for trust, responsiveness, and service quality in an increasing competitive marketplace. AI is not just a tool for incremental improvement anymore. It really is starting to reshape how the industry operates. From personalized underwriting using telematics and smart home data to instant claims approvals powered by AI-driven decision engines, the industry is moving toward faster, more customer-centric processes. We're seeing a shift from predictive AI, which analyzes historical patterns, to generative and agentic AI, which can automate complex workflows, create personalized communications, and even stimulate scenarios to anticipate risks in real time. Insurers who embrace these technologies holistically are likely to gain a clear competitive advantage while improving efficiency, lowering operational costs, and providing seamless customer experiences for the consumers. This wave of innovation does need to be balanced with robust governance. Insurers need a clear framework to prevent bias, ensure data privacy, and meet growing regulatory expectations while still innovating quickly and responsibly as well. Artificial intelligence is now embedded across nearly every stage of the insurance life cycle, fundamentally changing how insurers operate and how regulators must respond. In underwriting, companies are using telematics, credit data, and geolocation to dynamically price policies through proprietary platforms. This allows for real-time risk assessment and more personalized pricing models. In the claims space, AI tools are being used to analyze accident photos and medical documentation, which enables faster and more accurate repair estimates while also flagging potential fraud. These tools are streamlining the claims process and reducing the need for manual review. AI is also being used to monitor customer behavior. Predictive models can identify patterns in payment activity or even social media engagement to anticipate policy lapses or to identify opportunities for cross-selling and upselling. Finally, fraud detection has become more sophisticated, with AI analyzing massive data sets in real time to uncover anomalies and suspicious behaviors. Both insurers and regulators are leveraging these capabilities to improve oversight and ultimately with the goal of reducing losses. AI really just isn't assisting insurance companies. It's at the heart of risk evaluation, claims, and customer experiences. Already, some national companies analyze telematics data to calculate premiums dynamically for auto insurance, and some claim departments are adopting additional tools like computer vision technology that analyze accident photos and medical records to flag fraud and automate or to automate repair estimates. But when we aggregate all this information, we create extremely sensitive, comprehensive profiles of policyholders. This raises critical questions around privacy, fairness, as well as compliance. So let's talk about the versatility of AI. It really is a versatile tool in the insurance industry with applications that extend well beyond traditional underwriting and claims in the area of driving behavior. Telematics devices are capturing detailed data on speed, braking, routes, and driving times. This allows insurers to build highly individual risk profiles and even infer daily routines. From a financial perspective, predictive analytics are being used to assess indicators like late premium payments, credit card activity, and online purchasing behavior. These insights help flag potential churn of financial instability before it becomes a claims issue, before it becomes a problem. In health and lifestyle, you're integrating wearable technology to monitor fitness levels, sleep patterns, and stress. This data not only informs underwriting, but also supports proactive wellness initiatives. Perhaps most striking is AI's ability to forecast events such as car accidents, missed payments, or hospital visits, sometimes even before the policyholder or their physician is aware of the risk. These capabilities are redefining how insurers manage risk and ultimately engage with consumers. AI can create insights that policyholders never explicitly share. Telematics aren't just logging mileage, they're analyzing where you drive, creating a clear risk profile. In life insurance, some companies use fitness tracker data, monitoring sleep cycles, daily steps, and stress. Therefore, you're getting a better sense of what is going on in that insured's marketplace. Artificial intelligence is proven to be really something that in the insurance space, it's going to be tough to live without. Policyholder data is accessed by a wide range of entities in that regard. Each of them are playing, and we're on the next slide now. Each of them are playing a distinct role in the insurance ecosystem. Insurers themselves use this data extensively for underwriting, for claims processing, and fraud detection. These functions rely on accurate and timely information to assess risk, determine coverage, and identify suspicious activity. Vendors and technology providers also have access, particularly those offering AI analytics, claims management platforms, and cloud-based solutions. Their involvement introduces additional layers of data handling and potential exposure, which has to be carefully managed. Data brokers represent another category, aggregating consumer information from various sources and selling that for purposes of risk modeling. This practice does raise important questions about transparency and consent, especially when policyholders are unaware their data may be repurposed. Finally, regulators and auditors, including state departments of insurance and the NAIC, access policyholder data during compliance reviews and investigations. Their oversight is essential to ensuring that data is handled responsibly and in accordance with applicable state laws and regulations, as well as federal laws and regulations. So artificial intelligence brings powerful capabilities to the insurance industry, but it also introduces significant risk when not properly managed. One of the most pressing concerns is bias and discrimination. As systems in AI are trained on biased data, it can unintentionally replicate or even amplify inequities, which could lead to adverse or divergent outcomes for similarly situated individuals. Another issue is the lack of transparency. Many policyholders are unaware of how AI influences decisions in underwriting or claims, and they often have no clear path to challenge those outcomes. This can erode trust in the industry as well as the regulatory scheme and raises fairness concerns. Data misuse is also a growing risk. AI models may draw inferences from personal or sensitive data in ways that go beyond the intended scope of the data collection, potentially violating privacy expectations or regulatory boundaries. Finally, wrongful outcomes such as false positives and fraud detection or errors in facial recognition can lead to serious consequences, including reputational harm and legal disputes. These examples underscore the need for strong governance, transparency, and effective regulatory oversight in the deployment of AI in insurance. Algorithmic bias refers to the systemic unfairness that can emerge when artificial intelligence makes decisions that disproportionately disadvantage certain groups. The bias is not inherent to the technology itself, but stems from human involvement at every stage of the AI lifecycle. Bias can be introduced during the development of algorithms as the individuals who write the code bring their own assumptions and perspectives. It also can arise from the data used to train these models. If the data reflects inequities, the algorithm may replicate or even amplify those patterns. Finally, bias can be reinforced by how the results of the algorithm are interpreted and applied in real-world contexts. Understanding these sources of bias is essential for regulators as it highlights the need for transparency, accountability, and fairness in the design and development of AI systems in insurance and beyond. How did this case study happen? It was because of algorithmic bias. Before we get to the NAIC's work, let's define the issue. What is algorithmic bias? It's when, at its core, it's when AI makes decisions that could be considered systemically unfair to certain groups, often based on race, gender, or other protected traits. But how does bias enter a system that's supposed to be data-driven and objective? The answer is the human element. People write algorithms, select the data, and decide how to use the outputs. If those outputs reflect unconscious or structural bias, the AI can ultimately amplify and automate it. As we move forward, the focus now shifts from the operational and ethical dimensions of AI in insurance to the broader federal landscape. Understanding how federal developments are shaping the use of AI is critical for regulatory professionals. This next section will explore the emerging legislation, executive actions, and agency guidance that's out there that is really beginning to define the national framework for AI governance. These developments will have significant implications for insurers, regulators, and consumers alike. So it's important to examine how the federal entities are responding to AI. This next section will cover executive, legislative, and regulatory actions that are shaping the AI landscape. We'll look at initiatives like the Artificial Intelligence Action Plan, the FTC's Operation AI Comply, and recent rulemaking efforts that are aimed at fraud protection in the AI space. We'll also touch upon developments at the NAIC and NCOIL, including work streams and model laws and proposals that could influence how AI is governed across the insurance sector. So federal initiatives over the past few years have laid the groundwork for how artificial intelligence is governed and deployed across industries, including insurance. The AI Bill of Rights, which was released in 2022, introduced foundational policies and principles such as fairness, transparency, and privacy. These principles are now influencing how insurers structure their AI governance frameworks. Executive Order 14110, which was issued by the prior administration in 2023, took a more prescriptive approach by requiring bias testing, explainability, and risk assessment. These requirements serve as a model for best practices of AI deployment, particularly in high-stakes area like underwriting and claims. The NIST AI Risk Management Framework, which was also released in 2023, provides voluntary but influential guidance on managing AI risks. It offers insurers a structured approach to identifying, assessing, and mitigating bias and other harms associated with AI systems. Most recently, Executive Order 14179, which was issued earlier this year, signals a shift toward an innovation-first strategy. It emphasizes the development of a national AI action plan, which aims to balance responsible innovation with appropriate safeguards. A Bill of Rights is something that is being discussed. It's not legally binding, but it introduced certain principles out there. The executive order in 2023, we talked about a little bit. And really where we are now is with the current executive order 14179, the tone was really shifted. It's a new administration, reflects the current administration's actions on accelerating AI innovation. It removes some of the prescriptive guardrails, but called for National AI Action Plan within 180 days. This plan is expected to ultimately create some type of unified national AI strategy that will likely influence all regulated industries. So Americans' AI Action Plan, titled Winning the Race, was released by the Trump administration in July of 2025, and it represents a significant shift in federal AI policy. This 28-page framework is designed to position the United States as the global leader in artificial intelligence by emphasizing rapid innovation and deployment. The plan's built around three strategic pillars. First, it aims to accelerate AI innovation by reducing regulatory friction and increasing investment in research and development. Second, the plan focuses on building American AI infrastructure, which includes both physical and digital systems to support large-scale AI deployment. Third, it emphasizes leadership in international AI diplomacy and security, signaling a commitment to shaping global norms and protecting national interests. This initiative marks a significant move forward to a more innovation-first federal posture, with implications for how AI is regulated, funded, and integrated across sectors, including insurance. It also sets the stage for potential preemption debates and coordination challenges between federal and state regulatory frameworks. So the three pillars include focusing on removing barriers, build American AI infrastructure, and lead in international AI diplomacy and security. America's AI Action Plan is really a big change and outlines a bold new federal direction that prioritizes the private sector and global leadership. The plan aims to streamline federal processes to reduce regulatory friction and to accelerate AI development. The plan also references and reinforces several steps that the Trump administration has taken to respond to an evolving workforce. These actions include Executive Orders 14277 and 278, advancing artificial intelligence education for American youth and preparing Americans for high-paying skilled jobs in the future. The broader goals impacted by this approach are far-reaching. We can expect faster AI development, increased job opportunities, and a redefined regulatory landscape. However, these benefits do come with challenges, including the need to safeguard civil rights and liberties in an event of rapid technology change. Industries expected to be most effective include technology, manufacturing, construction, energy, healthcare, the private sector, cybersecurity, and insurance. For insurance regulators, this means preparing for a more dynamic and complex AI environment that will require adaptive oversight and cross-sector collaboration. On July 1st of 2025, the Senate voted overwhelmingly, 99-1, to strike the proposed 10-year federal ban or moratorium on state regulation of artificial intelligence from the broader One Big Beautiful Bill Act. The amendment, which was introduced by Senator Marsha Blackburn, was a significant development with widespread potential impacts for the state-based system of insurance regulation. The original moratorium would have preempted state authority, remember states regulate insurers, by prohibiting any state-level laws or regulations that were specifically targeting AI models, systems, or automated decision-making tools for a full decade. This raised serious concerns among state regulators, particularly in the insurance industry sector, who viewed it as a direct threat to their ability to oversee and work collaboratively with the industry on emerging AI applications within their particular jurisdictions. The Senate's decision to remove the moratorium preserves the regulatory autonomy of states and allows them to continue developing tailored frameworks to address
risks.
To address the risks and opportunities posed by AI.
Insurance and other industries.
And I think I'm hearing some feedback. But now I don't, so that's good. This outcome reinforces the importance of state-level engagement in shaping responsible AI governance. Operation AI Comply, which was launched by the Federal Trade Commission on the next slide in late 2024, represents a significant step in federal enforcement targeting deceptive practices involving artificial intelligence. It's a huge issue out there. The initiative is focused on companies that make false or misleading claims about their AI products or services, particularly those that exploit consumer trust in emerging technologies. In its early phase, the FTC brought 5 enforcement actions against businesses misusing AI. These included operations offering AI robot legal services without proper licensing, operations promoting passive income schemes that were powered by AI, and operations selling deceptive AI-driven e-commerce packages. Other cases involved AI writing tools that generated fake testimonials and services that were falsely promising guaranteed income from online storefronts. For instance, for insurance regulators, this initiative underscores the importance of scrutinizing AI-related marketing and service claims. It also signals that federal agencies are prepared to act when AI is used in ways that mislead consumers or violate existing laws. As AI becomes more integrated with insurance operations, ensuring transparency and accuracy into how these tools are represented will be critical to maintaining public trust and compliance. The Centers for Medicare and Medicaid Services launched the WISER model in June of 2025 to address fraud, waste, abuse, and other anomalies within Medicare. This initiative represents a significant shift towards using advanced technologies, including artificial intelligence, alongside clinical expertise to streamline prior authorization processes for services that are frequently missed. The model is designed to ensure that beneficiaries receive appropriate and necessary care while protecting taxpayers from excessive spending, which can account for up to a quarter of total healthcare costs. It also aims to reduce patient exposure to low value or unnecessary services that may ultimately carry risks without meaningful benefits. Participating companies will be assigned to specific regions and compensated based on their effectiveness in reducing inappropriate utilization and lowering costs. Importantly, these efforts must still align with existing Medicare coverage and payment standards. For insurance regulators, this model also offers a glimpse into how AI can be integrated into public health programs to improve efficiency and oversight. It also raises questions about how similar approaches might be adopted for private insurance and private insurers. In July of 2025, the Department of Justice announced the largest healthcare takedown in U.S. history. They charged 324 individuals in schemes involving over $14.6 billion in unintended losses. This unprecedented enforcement action underscores the federal government's intensified focus on combating fraud in Medicare and Medicaid government-sponsored programs. In addition to the takedown, the DOJ introduced two major initiatives aimed at strengthening its long-term fraud prevention and enforcement capabilities. The first is the creation of the Healthcare Fraud Data Fusion Center, which will integrate advanced analytics, artificial intelligence, and inter-industry collaboration to enhance fraud detection and prosecution. This center represents a significant investment in data-driven enforcement strategies. The second initiative is the DOJ HHS False Claims Act Working Group. This group is ultimately designed to coordinate efforts between the DOJ and the Department of Health and Human Services, focusing on priority enforcement areas such as Medicare, Advantage fraud, illegal kickbacks, defective medical devices, and drug pricing abuses. For the insurance industry, these developments signal a broader federal commitment to using AI and cross-agency collaboration as well to root out systemic fraud. They also highlight the importance of aligning state-level oversight with federal enforcement priorities. The NAIC has established several key working groups and work streams to guide regulatory oversight of artificial intelligence in the insurance sector. The Innovation, Cybersecurity, and Technology, or H Committee at the NAIC, is leading efforts to develop foundational frameworks, including a model bulletin that outlines expectations for insurers using AI. This bulletin is intended to promote consistency, transparency, and accountability in AI deployment. The Big Data and Artificial Intelligence Working Group within the H Committee is another critical component. One of its major initiatives is the Life AI ML Survey, which gathers how life insurers are using machine learning and other AI tools. This survey helps regulators understand current practices and identify areas where additional guidance or oversight may be needed. The NAIC has also launched a collaboration forum on algorithmic bias. This forum brings together regulators, industry stakeholders, and subject matter-driven experts to address concerns about fairness and discrimination in AI-driven decision-making. These work streams collectively reflect the NAIC's commitment to ensuring that innovation in insurance is balanced with consumer protection and regulatory clarity, which is key. The Big Data and Artificial Intelligence Working Group, again, part of the A Committee, plays a key role in shaping how artificial intelligence and machine learning are integrated into the insurance sector. For 2025, the group has outlined a plan that's focused on research, oversight, and regulatory support. The group is actively investigating the use of AI and machine learning in insurance operations. This includes analyzing how these technologies affect underwriting, how they affect claims, and how they ultimately affect operations and consumer interactions. Findings will be communicated to the Innovation, Cybersecurity, and Technology Committee along with policy recommendations. The group is closely tracking AI developments at the state, federal, and international levels to understand the impacts of these regulations and developments for insurance laws and regulations. This ensures that the U.S. insurance regulators and their oversight remain aligned with global trends, which is important. The group facilitates discussions among regulators and stakeholders to help evolve regulatory frameworks for AI. This includes identifying gaps and proposing updates to ensure responsible and effective oversight. Another major focus is promoting the adoption of the NAIC Model Bulletin titled The Use of Artificial Intelligence Systems by Insurers. Lastly, the group is working to develop resources, guidelines, and training programs to help insurance regulators evaluate AI systems and to better understand big data techniques. The NAIC released an exposure draft of the Model Bulletin in July of 2023. The bulletin is designed to be adopted by state departments of insurance and shared with insurers to guide the responsible use of advanced analytical and artificial technologies, including artificial intelligence systems. It emphasizes the importance of insurers implementing policies that ensure that AI does not lead to unfair discrimination or unfair claims settlement processes. The bulletin reflects a growing regulatory focus on aligning technological innovation with consumer protection and ethical standards. The map on the screen visually highlights the jurisdictions that have adopted the AI bulletin, as well as those that have issued insurance-specific regulations or guidance related to AI. This growing adoption reflects a strong national trend toward establishing consistent expectations for how insurers deploy AI technologies. It also underscores the importance of aligning regulatory frameworks to ensure business, transparency, and accountability in the use of predictive models across the insurance sector are being used in a certain methodology and way. In May of 2025, the NAIC issued a request for information to gather stakeholder input on whether there's a need for uniform statutory requirements governing the use of AI in insurance. This report specifically asked for feedback on how a potential model law could and should address key principles such as governance, transparency, and accountability. The initiative is a clear signal that the NAIC is seriously considering drafting a model law, and the request serves as a foundational step in that process. The working group received a wide range of comments from insurers, state regulators, AI vendors, and other stakeholders. Notably, the Colorado Division of Insurance, which has been a leader in AI-related insurance regulation, expressed strong support for developing a model law, which some states have expressed their view that no model law is needed at this time. Some respondents, such as the Ohio Insurance Department, don't believe a model is required at this time. The National Conference of Insurance Legislators also weighed in, emphasizing the importance of ensuring that the NAIC model aligns with and does not conflict with NAIC's existing draft model law. These varied perspectives highlight the complexity of building consensus around AI regulation in the insurance space. In July of 2025, NCOIL's Financial Services and Multi-Line Insurers Committee issued a draft model act focused on insurers' use of artificial intelligence. One of the central provisions in any decision is that any decision to deny a claim or any portion of it must be made by a qualified human professional. It can't just be made by AI or a machine, if you will. AI systems cannot be the sole basis for such denials. Insurers are also required to maintain detailed records documenting the human professional's involvement in the claims decisions. Additionally, denial communications must include a contact for further information and must clearly state that an AI system was not the sole reason for the denial. The draft gives state insurance commissioners authority to enforce compliance with these requirements. Feedback from trade organizations has been mixed. Some have pointed that the Model Act is based on legislation that previously failed in Florida, specifically Senate Bill 794. Others have expressed concern that the draft takes a one-size-fits-all approach and have called for a more nuanced and comprehensive discussion to shape future regulation, which is not an uncommon thing to happen at the NAIC level. So now that we've explored the national landscape and the evolving role of the NAIC and NCOIL in shaping AI regulation, let's shift our focus to what's happening at the state level, literally as we speak. States are not waiting for a uniform national regulatory framework. They're actively developing their own approaches to AI oversight in insurance. This next section will highlight key state initiatives, legislative trends, and regulatory actions that are shaping how AI is being governed across different jurisdictions. Let's now take a closer look at 6 states that are actively shaping the regulatory landscape around artificial intelligence and insurance. Each of these jurisdictions, Louisiana, my home state of Florida, California, Texas, Colorado, and New York, have taken distinct approaches, whether through legislation, regulatory guidance, or enforcement activities. These states offer a representative snapshot of the broader national dialogue, highlighting both innovation and divergence in how AI oversight is being implemented. In the following slides, we'll explore the specific actions and trends emerging from each of these states. In July of 2025, the Louisiana Department of Insurance introduced Regulation 134 under the authority of Act 229 from 2024. This regulation establishes a formal insurance regulatory sandbox program, allowing entities to test innovative insurance products or services on a temporary basis. Through the program, the commissioner has the discretion to issue pending innovation waivers that exempt participants from certain state laws during the testing period. These waivers were granted only if the proposed innovation does not pose an undue risk to consumers, and also if it avoids creating unfair competitive advantages as well as serves the public interest. The sandbox is open to a wide range of applicants, including insurtech startups, traditional insurers, AI and fintech developers, and academic institutions engaged in the area of insurance research. The initiative reflects Louisiana's commitment to fostering the innovation of insurers while remaining and maintaining high regulatory standards. In 2025, similarly, the Louisiana Department of Health launched a new fraud, waste, and abuse task force aimed at strengthening oversight and accountability within the state's Medicaid program. The task force is initially looking and focusing in 3 strategic areas. First, it's partnering with the Office of Motor Vehicles to improve the accuracy of Medicaid enrollment data through enhanced data shaping. This will ensure that the state is not paying monthly premiums for individuals holding an active driver's license in another state. Second, it's leveraging artificial intelligence and data analytics to proactively identify patterns of waste, fraud, and abuse. Third, it's fostering collaboration between the Louisiana Department of Health Program Integrity Unit and the Attorney General's Medicaid Fraud Unit to enhance detection, investigation, and prosecution capabilities. These efforts are designed to maximize recoveries and ensure the Medicaid resources in the state are used effectively efficiently, and ethically as well. In early 2025, we're still on Louisiana Economic Development Department launched Louisiana Innovation, also known as LAIO, to enhance and drive economic modernization through strategic investment in artificial intelligence. The initiative's first major project is a public-private growth fund exceeding $100 million aimed at accelerating innovation across the state. In addition to funding, the LAIO will establish the Louisiana Institute for Artificial Intelligence to lead research, development, and commercialization efforts. A key component of this initiative is the plan to equip 5,000 small businesses with AI tools, training, and support to enhance their competitiveness. The program's also built on strong public-private partnerships, including collaborations with the Tulane Innovation Institute and the New Orleans Startup Fund. This marks a significant step in positioning Louisiana as a hub for AI-driven economic growth. Similarly, in Florida, Senate Bill 794 was introduced during the 2025 session, aimed at establishing clear requirements for human oversight in insurance claim denials. The bill would have required that qualified human professionals independently review the facts of each claim and the applicable policy terms without relying solely on automated systems. It also mandated that insurers deliver detailed records and maintain detailed records documenting the identity and actions of the human professionals involved in any decision-making process. Importantly, the bill prohibited the use of algorithms, AI, or machine learning as a sole basis for adjusting or denying claims. Claim denials would need to identify the responsible human reviewer and confirm that the decision was not based solely on automation. The Office of Insurance Regulation under that bill, which did not pass, would have ultimately been empowered to examine and investigate insurers for compliance. Through similar legislation in California, Texas, and Tennessee, even though it was similar, this proposal did not pass during the 2025 session, highlighting the ongoing dialogue over balancing innovation with consumer protection. California continues to be active in shaping artificial intelligence and data privacy policy, particularly in the insurance and healthcare space. Assembly Bill 3030, effective January 2025, requires health insurers to clearly disclose when AI or automated decision-making is being used in conjunction in communications with patients and policyholders. This measure ensures transparency. It helps consumers understand when AI is influencing their coverage decisions or claims experiences as well. Senate Bill 942 and Assembly Bill 2013 built on this foundation by mandating clear explanation for AI-driven decisions that affect consumers. Whether this is used in underwriting, fraud detection, or claims processing, insurers must ensure their systems are explainable to both regulators and consumers. Senate Bill 1120 reinforces the importance of human oversight by prohibiting insurers from using AI as a sole basis for denying healthcare claims. Meanwhile, the CPPA, the California Privacy Protection Act, is preparing updated rules that will impose stricter standards for data handling and algorithmic accountability. These rules are expected to increase insurer responsibility insurer responsibilities around data minimization, fairness, and accuracy in AI models. Finally, the California Attorney General has issued guidance confirming the existence of rights and privacy laws and saying that they fully apply to AI and their systems. This underscores the need for insurers to actively monitor their models to prevent bias and ensure lawful, equitable outcomes. Together, these initiatives reflect California's comprehensive and common sense approach to responsible AI governance, setting a benchmark for other states driven by consumer protection motives and influencing national policy discussions as well. So let's take a closer look at Senate Bill 1120. In 2024, the California Senate enacted Senate Bill 1120, which represents a significant step in regulating the use of artificial intelligence and utilization reviews and utilization management of decisions. The law establishes that underwriting decisions have to be grounded in relevant applicable criteria, including a patient's history, specific circumstances, and documented information rather than relying solely on generated data sets. Importantly, this bill affirms that the healthcare provider must retain full authority over these discussions and decisions. It also requires that any AI or software used in the process be subject to periodic review and made available for inspection. Additionally, health plans must disclose how AI or similar technologies are used and overseen within their written underwriting policies and procedures. The legislation that I just described sets a potential precedent for how other states may approach AI oversight in healthcare and insurance contracts. Texas has since followed California's approach and has taken action to regulate the use of artificial intelligence in healthcare coverage decisions. Texas Bill 815 was signed into law in 2025 and places firm restrictions on the use of artificial intelligence in utilization review processes. These systems may still be used for administrative functions or fraud direction where they do not directly impact clinical decisions. To ensure transparency and accountability, Senate Bill 815 in Texas also grants the Texas Commissioner of Insurance the authority to audit and inspect how AI systems are being deployed by health plans and review agents. This oversight mechanism is designed to prevent the misuse of this technology and to ensure compliance with the law as well. Colorado is in there taking a national leadership role as it relates to regulating the use of artificial intelligence and insurance. It became the first state to issue a regulation specifically targeting algorithmic bias in life insurance. The regulation was passed by the Colorado Division of Insurance under the authority of Senate Bill 21-169, which passed in 2021. The rule prohibits insurers from engaging in unfair discrimination through the use of external data sources or AI models. It applies broadly to both proprietary and third-party algorithms. Starting December 1st of last year, 2024, insurers are required to submit annual attestations confirming compliance. The Colorado Division of Insurance also has signaled its intent to expand other regulatory requirements to the property and casualty sector, including potentially a broader commitment to responsible AI governance across insurance lines. Colorado continues to be a leader in this space with two significant developments on the next slide. First, you have the Division of Insurance, go back one. The Division of Insurance has initiated formal rulemaking to amend Regulation 10-1-1. These amendments will broaden the regulation scope to include private passenger auto and health benefit plan insurers while also updating requirements for life insurers. The changes aim to strengthen oversight of how external data and AI are used in underwriting and rating practices. Second, Senate Bill 24-205 introduces broad consumer protections for artificial intelligence. Beginning in February of 2026, developers and users of high-risk AI systems must take responsible steps to prevent algorithmic discrimination. The bill outlines specific compliance measures and recognizes these entities, like insurers and banks, that follow their industry-specific AI regulations will be deemed in full compliance. These efforts reflect Colorado's comprehensive approach to balancing innovation with consumer protection. In New York continues to be a national leader in AI regulation, particularly in the insurance space. The Department of Financial Services issued circular letter number 7 in 2024, which requires insurers to conduct bias testing, maintain detailed documentation, and provide consumer disclosures for AI-driven decisions across all lines of insurance. In addition, DFS has issued cybersecurity guidance that includes AI-specific risk controls to address data misuse and cyber vulnerabilities. The state legislature has also passed the RAISE Act in 2025, which is currently awaiting the governor's signature. This legislation targets developers of frontier AI systems and could impose vendor accountability standards for insurers. It prohibits the development of frontier models that present an unreasonable risk of critical harm and grants exclusive enforcement authority to the New York Attorney General. Collectively, these actions reinforce New York's role in setting the national tone for AI and data governance in financial services. Several southern states are actively involved in AI-related legislative and regulatory efforts, each taking a distinctive approach. In the interest of time, I'll just tell you on the screen you have Mississippi, Tennessee, and Alabama reflected in what they did there. Some additional states to watch on the next slide include Utah, Illinois, Maryland, New Jersey, and Washington as well. Key takeaways at the federal level, the U.S. has laid foundational guidance through initiatives like the AI Action Plan, the AI Bill of Rights, Executive Order 14179, and the NIST AI Risk Management Framework. These documents collectively shape expectations around responsible AI development and deployment. The NAIC has also played a central role with its 2023 Model AI Bulletin, establishing key principles for fairness, transparency, and vendor accountability in the insurance sector. Meanwhile, states such as Colorado, California, Florida, Texas, and New York are leading the charge with their own AI and privacy regulations. As I suggested earlier, we're not going to be able to get to the privacy portion of this. That starts on the next slide. Mary Ellen will send these slides around to the participants, as well as my email address for any, which is on the next slide, for any questions. It's the Thursday before Labor Day. Thank you all for spending an hour with me on talking about what is a very timely and important topic. With that, I will turn it back over to Julie.
Thank you so much for sharing your expertise with us this afternoon and for being such a good friend to SILA and the SILA Foundation. We really do appreciate you and all of the time that you give to us. As a reminder to everyone, our webinars are free of charge and open to the public. We really appreciate you sharing our invitations. We'd like you to watch for and complete the post-webinar survey and join us next month for our annual fireside chat with the outgoing NASA president.